I'm Marella Fernandez. Thanks for joining us and welcome to Market Call. Christine Poole on the show today. She's Co-Chief Investment Officer at Davis Rea, and she's taking your questions on North American large caps. Call us toll free 1-855-326-6266. You could also send your question in through an email, marketcall@bnnbloomberg.ca. Christine, thanks for coming in.
Thanks, Marella.
We still have that pause on American tariffs by Donald Trump, and I'm wondering if you see that still overhanging the market and what you're seeing as a result.
Definitely overhanging the market, and it's causing a lot of uncertainty. It does indicate that he may be flexible to negotiate with other countries, and he's indicated that many countries have reached out. But I think we need to see some progress and some definitive news on any trade deals. But right now, we're seeing consumer confidence, business confidence has plummeted to very low levels because no one knows what's going to happen. Typically, when confidence is low, businesses wait. They don't do anything. They're sitting on their hands because they don't know how this is going to unfold. And that usually leads to slower growth, less hiring, which is headwinds to the economy.
Trade war is one thing. There's also the discussion with the Federal Reserve Chair, which is Donald Trump saying he should lower the rate. And there's now a discussion about whether or not he can be fired.
Yes.
What's your take on that playing out?
Well, that's also, I think, what's causing the pullback we're seeing today, because the Fed is supposed to be an independent organization. And we don't know legally, is he allowed to fire him? There's a debate because I think, perhaps, he has to prove that somehow it's cause. So what is cause? And I think for Fed Chair Powell, he indicated last week, he knows that these tariffs are creating uncertainty. Typically tariffs, they increase costs because imports are more expensive. Typically companies will try and pass that on to the consumer. So the higher prices result. And then as well, what happens is demand may actually slow. So monetary policy is actually not really that effective in an environment, let's say a stagflation environment where you have a slowing, stagnant economy and rising prices. So he wants to kind of wait and see. Eventually, if prices do go up because of tariffs, then you will get slower economic data. And so eventually, I think the central banks will have to cut. In Canada, we've seen last week he paused as well after cutting for seven consecutive times because for the wait and see. But the Canadian economy is on weaker footing than the U.S. economy. Unemployment is much higher. So I think eventually, consensus is that eventually all central banks will continue to cut rates further along later on in the year.
Why do you think Canada is feeling more of an effect right now than the U.S.? You would think the U.S. would feel the effect more immediately than Canada. Well,
I think it's been for Canada, it's been the last few years, like the last year and a half, because of higher interest rates and our reliance on variable rate mortgages, et cetera. And so our employment rate has gone up quite a bit. And so I think that's why the Bank of Canada has cut much more aggressively starting June of last year. And so that's why our rates are much lower than it is in the United States, whereas in the U.S., the economy actually has been quite resilient, and unemployment is still at 4.2% versus 6.7% in Canada.
Got it. All right, we are going to take a break, line up your phone calls. We'll be back with Christine Poole, Co-Chief Investment Officer at Davis Rea, taking your questions today on North American large caps. Back in a moment. Welcome back. Let's go to your emails first. Steve has sent in an email for Christine. It says, what do you think about ENB, Enbridge, or PPL going forward? I'm a retirees are looking for income and preferably lower volatility, which everybody's looking for these days.
Yeah, so Enbridge and Pembina Pipelines, both infrastructure names, Canadian names. And we actually do own those names for income in our client portfolios, Marilla. And we do think that, they have a very robust business model. Many times it's the contracts for Enbridge in particular, it's long-term take-or-pay contracts, so very visible cash flow streams. Pembina as well has that structure in place. And I think that their dividend, that both companies have guided that they expect that they can grow their EBITDA or their cash flows kind of in that mid-single digit range over the next few years. And so we would assume that dividend increases would largely reflect that. So, not, strong dividend increases, but still some dividend increases. And as well, the yields are pretty attractive. I think for Enbridge, the yield is around 6% right now, and Pembina is 5.3%. The stocks have pulled back with I think the pullback in the underlying commodity prices. That tends to happen because they are classified under the energy sector, but definitely they should have lower volatility than, let's say, the energy producing companies.
I was going to say their exposure is not as much because they're just providing the distribution service.
Exactly, they're transporting the natural gas or the crude oil, and as well midstream operations.
Okay, let's go to the phone lines then. We have on the line Dominic calling from Montreal. Hi, Dominic, what's your question?
Yes, hello. Thank you very much for taking my call. I'm calling about Intuitive Surgical. I'd like to have Christine's insights on the company. I'm interested in knowing if the customers or income that comes into this company, does it come generally from governments, corporations, or the individual? Is it international or mostly U.S.? And would you consider it a defensive stock? And finally, Christine, how is the Canadian hedged version of Intuitive derived from the full stock? I'm interested in the math of it.
Okay, thanks for your question, Dominic. So they make and manufacture scalpels, that kind of thing, but also robotic versions of those.
That's right. It's kind of using robotics for surgical operations. I think it's primarily U.S. based, and in terms of who's buying their equipment, largely hospitals. So there is funding concerns. If there's less funding, potentially there's less demand for their products. It is obviously a technology. Robotic surgery is on the rise, and I see that long term there is very good secular growth. The thing is, the stock does tend to trade at a very high multiple. And when rates are high, which we saw the last couple of years, hospitals pause on budgets because that's more costly. As well in the United States with, President Trump examining all their expenditures and talking about decreasing funding potentially for various departments and areas, that could have an impact as well for hospitals. But so for those reasons, even though I do think robotic surgery and their products will have long-term secular demand, given the multiple it trades at and some of these overhangs where we have not added it to client portfolios.
And you wouldn't really consider it then a defensive stock so much?
No. I think the more defensive areas in healthcare tend to be the pharmaceutical names to a certain extent. We own a few of those, and they actually have held up relatively well.
Got it. Okay, let's go back to the phone lines. Kirk is on the line from Calgary. Hi, Kirk.
Hey, good morning. Christine, I wanted to get your thoughts on Newmont Corporation. With the gold there, it seats at the record again today. So just kind of where you see gold going and if you like Newmont as a gold play. Thanks.
Sure. Yeah. So gold has done very well, given all this uncertainty and volatility. Historically, typically we don't invest in commodity-based sectors, so we haven't really participated in the rally in gold prices. I guess if you want gold exposure, and I get asked this question, where would you put your money? And my preference has always been Agnico. Or Franco-Nevada. Agnico, just because they're in low political risk regions, a large growing operations and mines, very well managed, and executes well. And then Franco-Nevada is obviously a royalty company, so they take a royalty on the top line, and you don't necessarily have to really worry too much about the operating costs of the underlying mines. And both those companies have performed very well long term over the cycle. So I guess Newmont isn't a name we own, and if we wanted gold exposure, it would be one of those other two companies I've talked about.
Got it. Okay, let's go back to the phone lines. Steve is on the line. Steve is calling from Toronto. Hi, Steve.
Hello. Thank you for taking my call. I'm looking at getting into the TD Bank. It's been pretty resilient lately, even though with a lot of market turmoil. And I'm wondering if you would step in at this price level. Thank you very much.
Yeah, TD Bank has rebounded since the end of the year.
Yes. I mean, as we all know, the stock pulled back quite a bit when they had those anti-money laundering penalties put on them by the U.S. government. And that asset cap is going to be in place for a number of years, but the bank is working around that. And the U.S. accounts for about 25 or 30% of its earnings, so it's not just a U.S. bank. So I think they feel that they can still focus and grow within Canada. And would we buy here? We do own TD Bank as one of our bank positions in our client portfolios. It does, even though it has been somewhat more resilient because of the pullback previously to before this year, valuation on TD Bank is still quite attractive, trading at about 10 times earnings, and the yield is quite attractive as well. So this is a bank holding that we own. Okay,
and you'd still dip in. I guess people think they've missed the bottom, and should they still dip in even though it's on the rise?
Yeah, no, I don't. I mean, I think this is going to be the path back to growth is going to take a while, and the valuation got very depressed when those charges were announced, or those penalties were levied. So we still think that the valuation is attracted, and over time, it can still grow, and eventually, hopefully, the asset cap, when it gets lifted in the U.S., that will also become more of a growth source for the company.
Got it. Okay, we are going to take another quick break, but Christine is sticking around to take your questions. She's Co-Chief Investment Officer at Davis Rea, and she's taking your questions today on North American large caps. We're back in a moment. Welcome back to Market Call. We want to go right to your questions. And Richard has written in. He says, what do you think of Loblaw? Nice, short, sweet question there. What do you think of Loblaw?
Well, Loblaw is a name that we own in our client portfolios, and we have for a few years. The stock's held in, well, it's done actually remarkably well because it's really considered a defensive name when markets turn volatile and there's risk of economic slowdown. And the outperformance actually started, maybe a couple of years ago when interest rates started to increase and the Canadian economy started to slow. And for Loblaw, they have a lot of their discount banners. It's over 50% of their banners are discount. So they saw more traffic gravitate to their discount banners, and that's really helped to drive their traffic there. And then as well for Shoppers, there's also a leading drug retail through Shoppers Drug Mart. We've seen increased scope of services. The governments are allowing the pharmacists to do more, give you vaccinations, shots for various things, assess kind of more of the not serious or
illnesses, yes.
Medications. And so that's helped to drive traffic to the pharmacy. And that also helps the front end of the store, which is where you buy all the merchandise. Back end is the pharmaceutical services. So Loblaw has seen that opportunity, and they plan on opening more pharmacy-based clinics across Canada. So, and the company's been executing very well. They had a new CEO come in back in 2023. They've implemented a new IT system. You're seeing the benefits of that. And so, like I said, again, it's a considered consumer staple. When we first bought the stock a few years ago, maybe 4 or 5 years ago, it was actually trading at a discount to Metro, one of their competitors.
Interesting, okay.
And it was trading at a mid-teens multiple. Now the shares are trading at like 22 times forward earnings. So it's not really inexpensive. I would wait for a pullback to add to it for new client money. But definitely, in an environment like this, consumer staple names like Loblaw's outperforms and does well, and they're executing as well.
Do you think that it is their discount lines or stores that are sort of holding things up, considering the times we're in now where people are looking for better deals and we could be facing a recession?
Yeah, I think the discount banners have been holding up better, and they've commented that in their calls. And as well, Morel, as you probably know, they have a very strong private label brand pack portfolio, and so obviously those are lower priced, and that's also helping them.
Sounds good. Okay, let's go back to the phone lines. Peter's on the line from Mississauga, Ontario. Hi, Peter.
Hi.
What's your question?
Thanks for taking my call. I'm just going to ask Christine's opinion of Amazon going forward from this point.
Sure.
Okay,
yes.
So Amazon, I just want to pull that up. It's at 166 now, and of course fallen off mid-February from 242.
Yeah.
So it's still going down.
Yeah, so a lot of these large cap tech stocks that drove the markets the last couple of years in the United States have seen very big pullbacks. I think Amazon's probably off close to 30%. The multiple definitely is much more attractive now. I think it's actually even trading to a discount to Walmart.
Wow.
But, it's not a name that, we've added to our segregated portfolios. We do own it in our kind of more equity fund, that Davis Rea equity fund, which is more of a U.S. growth focus. And I guess for Amazon, we all know, the Amazon Web Services has the leader in cloud computing, and that's really done well and helped to offset, lower margins on the retail side. But, I think the concern now is that with the economy slowing, with tariffs, that may impact what happens on the retail side in terms of spend. And then on Amazon, on the cloud computing side, we've seen all companies, all those large tech companies, increasing capex to build out data centers. And so there is a concern that they're maybe potentially overspending and not necessarily seeing the returns they want to see near term. So
can we talk about exposure as well, trade war? Because I don't know how much they bring in, for example, from China. They have a lot of name brands. So do they do a lot of importing?
I think they do. I mean, to get the lower cost, like we all know, to get lower price goods, you're going outside of North America to produce these goods, right? And I'm sure a lot of companies that are selling goods outside of their own brands are also very international. So with these tariffs, retaliatory tariffs, we'll have to see what he announced them on all countries. It wasn't just China. Right now, the pause only applies to China, but he kind of included all countries, which very surprising to the market. So we really have to see how this plays out over the next 90 days.
Okay, so it's kind of a hold for you at this point.
Yes.
Got it. Let's go back to the phone lines. Joan's on the line from Richmond Hill in Ontario. Hi, Joan.
Hi, how are you?
I'm good.
I'd like to ask about Precious Jewelry. This stock is so fishy. I don't know why. It usually is a very good stock, and I don't know why they down so much. It's so terrible for me. Thank you.
Thank you. So Precision Drilling is what she's asking about.
Yeah. So it's an energy services company. So they provide drilling services to energy producers. And so their customers are oil and gas companies. And so typically, and it does get swayed by what the underlying commodity is doing. And so we know that the energy sector in general has come off because, crude oil is at $67. It's coming off. It's been weak on the fact that, if we have a slowing global economy, less demand for energy. We've seen OPEC potentially saying that they're actually going to put on additional, they've been having cutbacks, but they're not going to continue those cutbacks. So which is kind of bizarre because you think that with demand potentially weakening, that they would keep those cutbacks in place.
It's doing the opposite.
Yeah, they're doing the opposite, which maybe implies that some of these countries, they need energy revenues generated from energy to drive their economy. And so with prices coming off now, they need the volume to offset that. And then I read, I guess more recently, there's been developments, the US and Iran are talking, and so potentially you might see more, if things come to some sort of agreement, you could see more production coming out of Iran. But having said all that, Precision Drilling, their services will weaken when energy companies decide to pull back on spending, on drilling activities. And when do they pull back on drilling activities is when the commodity's weak and there's less money to spend. And so that's what we're seeing. And so it does tend to be very volatile, maybe even more volatile than the energy producers. It's not an area that we usually invest in because of the volatility. As I said before, when we were talking about Enbridge and Pembina, we tend to stay with those infrastructure names in that sector.
And do they generally operate in North America? Are they more Canadian focused, or are they international?
They're primarily more North American focused, yeah.
Got it. Okay. Let's go back to the phone lines then. Judith is on the line from Barrie. Hi, Judith.
Hi, good afternoon. I'd like to ask Christine about South Bow, please.
Okay.
I think it's a spin-off.
Let's have a look at South Bow, which we've talked about before. How has it been doing, and generally, how do you see it moving forward?
Well, yeah, I think South Bow was spun off by TC Energy. So I think it's primarily natural gas now because TC Energy kept, so maybe it's the reverse. They spun off they had natural gas pipelines and crude oil pipelines, and they decided to spin off the crude oil pipeline.
Okay.
And so, like I said, my comment on the pipelines before, generally more defensive in the energy patch, and potentially in the future, if we get talk of, in an environment where new pipeline development is more welcome, that will benefit these companies. There's nothing wrong with South Bow necessarily, but we already own 2 pipelines, and we don't feel the inclination to switch on one of those and replace it with South Bow.
Got it. Okay. South Bow, I have here as a crude oil supply. So it also could take a hit, just, I guess, with everything else moving down.
Yeah.
Got it. Okay. We're going to take a quick break. When we return, we'll take a look at Christine's past picks. What's coming up next? Welcome Welcome back. Time now for our guest past picks. Christine Poole is here, and her picks are from March 21st of 2024. At the time, she picked Alphabet, which of course is Google on the NASDAQ, and it has been hit by that downward slide in February. So it was 147.60. It's now 147.55. If we had looked at the start of the year, it'd be a different story. So down under 1% and a 1% up total return. We know what has happened there, but we were talking about the break. They're also in court in the U.S., which sees them as a monopoly in certain circumstances. And do you have concerns about that at all?
Well, it's always a concern because you're being sued by the U.S. government, and they're kind of focused on all these large cap tech stocks, saying that they have monopolies. In this case, for Alphabet, it's on their search engine business, and so we'll have to see what evolves. But eventually, Google has already said, Alphabet says they're going to appeal. So I think that this will probably be played out for over a number of years, but definitely the headline risk is not good for the stock, so that's been an overhang. And as well, another overhang, and we talked a little bit about this with Amazon, when they reported their last quarter, they indicated they were going to increase their capital spending for data centers by by quite a large amount, like over 40 or 50%. And that was a surprise to the street because they had already increased it by quite a bit in 2024. And so once again, the concern that, they're spending all this money, when's the payback? And then they also have a cloud computing business, Google Cloud, which grew 30% year over year. So that's quite healthy, but the expectation was that it was going to grow like 32%. So the analysts didn't like that, and the stock had come off. So for all those reasons, then we've seen this pullback in the market, generally speaking, and all, especially focused on large cap tech. So now the stock's trading at about 17 times forward earnings. The consensus that they can still grow their earnings per share kind of around the 14-15% range. So I think it's actually, if those earnings hold, and we'll get more visibility as they report, I think this week, or maybe probably this week, I think, that it's trading at a very attractive multiple. It's actually trading at a lower multiple than the overall S&P 500 now. So yeah, we own it, and we'd be buying it for new money here.
Got it. Okay, let's go to your second past pick, which is Mondelez, MDLZ or Z on the NASDAQ. At the point, it was 72.21 American, and now down to 67.39. So a drop return of 7% and 3% total return. What's going on with Mondelez?
Yeah, so Mondelez, like over the past year, it's down, but you can see if you put a year-to-date chart, the stock's actually held up really well in this environment of uncertainty because it's a consumer staples stock, leading player in chocolate and in biscuits, number one in biscuits, number two in chocolate. So it's a snacks company. About 40% of its revenues are from emerging markets, which tend to have stronger, longer-term secular growth. So those are the reasons why we own it, and we still continue to. But what's happened in their chocolate business, which is about 30% of their revenues, cocoa prices have spiked up quite a bit. And they were largely hedged for last year, so they didn't really feel the impact. But then coming into this year, cocoa prices have still stayed elevated. They were hoping that it would start to weaken. And so they guided down when they reported last quarter. And so the earnings are going to be down this year. We don't, hopefully cocoa prices will eventually, so they kind of hedged for this year at these higher prices. So the stock came off on that, but it has since recovered somewhat because it is considered consumer staples. Demand for their products tend to be less cyclical. They will try to pass through some price increases to offset the increase in cocoa prices on their chocolate side.
Okay, so you would kind of hold on to it and wait for the turnaround in the cocoa price.
Because I think the long-term outlook is still attractive, and they're expanding into adjacent categories like baked goods and pastries, which they can leverage off. Like Oreos is one of their brands. They can leverage the brand into other categories, because the consumer knows their brand awareness is quite high. And private label penetration in their categories is relatively low.
Got it. Okay, let's get to your last past pick from March last year. Zoetis, which makes, I guess, animal vaccines and medication. At the time, it was 168.32. It's also gone down to 147.23, a 12% return drop and 11% total return drop. What have they been through over the last year?
Yeah, so Zoetis is the leading player in healthcare, animal healthcare. So they have Pet Companion, which is your pets business, which is 2/3, then livestock. So they provide vaccines and medications for the livestock that is also out there, and they cover all like 7 or 8 species. But the stock, we actually think that animal healthcare is very attractive longer term. However, it does trend to trade at a higher multiple because, and so I think you've seen some multiple contraction. They are leader in parasiticides, which is ticks, worms, and fleas for pets. That product has done very well. They've got a new pain management treatment out called Librela. It has received some negative press because there has been side effects when they administrate this to dogs, but it's to treat pain.
Okay.
But typically you give this to older dogs. So they have pre-existing conditions, so it's it's debatable whether their medication is actually causing an adverse consequence or because the dog is so old. But the company has maintained, and that they've had this drug out in Europe for much longer, and the veterinary industry still indicates they think it's a good product. It's a new kind of diagnostic product that pain management area has been very underpenetrated, so they see a lot of growth going forward. But that has been an overhang on the stock as well. But we continue to like it, and we would buy it here.
Got it. All right, we're going to take a quick break. Christine's sticking around to take more of your questions. Back in a moment. Welcome back to Market Call. We'll get right to your phone calls. Ron's on the line from Burlington in Ontario. Hi, Ron.
Hi, thanks for taking my call.
Go ahead.
I'm very interested in regional banks in the United States, the large regional banks like PNC, Truist, and U.S. Bank. They recovered after the pandemic, and now they're well off their highs again. I wondered what you thought about that as an investment. Thanks for your comments.
Sure.
Thanks, Ron.
Yeah, so I think for a diversified portfolio, you should have exposure to U.S. banks because the U.S. economy is such an important economy. And I tend to focus on the large cap banks. I know Ron mentioned regional banks, but and there will be consolidation, I think, in the regional bank area because we saw the regional bank crisis back in March of 2023, what happened there. So there probably will be continued consolidation. And in hopes of with the Trump presidency, supposedly there should be more deregulation and potential for more M&A, which would be positive for the large cap banks because they would probably want to look at the smaller regional ones. Having said that, you probably want exposure. Most of the large cap banks, many of them reported last week. Results were actually quite good, ahead of expectation. They saw strong trading activity, capital markets activity, but that was in the first quarter, because as you can recall, Marella, after Trump got into office, there was anticipation that because there would be lower taxes, deregulation, more M&A, all the banks kind of rallied on that, and they had a good upsurge in their stock prices. And then uncertainty now with the tariffs, slowing U.S. economy, potentially more loan loss provisions, which I think some of the banks did implement. They have fallen back, and that's what Ron is referencing. But I do think you want to have exposure. One of my top picks is going to be a U.S. bank, so he can listen, and I'll talk about that bank.
Do you think the enthusiasm has waned, but there's still hope for deregulation down the line?
Yes, I think, yes, it has waned because, the banks, when they commented on their call, yes, the first quarter was very good, but now you have to look forward. And we are seeing potentially if unemployment starts to increase, then because they put aside reserves based on expectations, that the positives of deregulation may be offset by higher tariffs. And no one knows how these tariffs are going to play out. And the geopolitical uncertainty around the world is so high. So, that once again, that could be overhanging the sector.
Got it. Okay, let's go back to the phone lines. Nazar is on the line from Scarborough, Ontario. Hi, Nazar.
Oh, hi, Marilla. Hi, Christine. May I have your thoughts on Manulife Financial, please? This Lifeco has worldwide operations with China facing a hefty 145% tariff and retaliatory threats by China in return. Will Manulife's revenue base not see a dampening effect going forward? It is trading below $40. It has reached a $46.50 high about 6 months back. Thanks for taking my call.
Okay,
Sure.
Thank you. So what Can you expand a little bit more on their exposure?
Yeah, so they have operations in Hong Kong. That's an area of growth for them. They sell life insurance products. And so Nazar is right that, that's been a source of growth, and that's actually been part of the reason why the stock's done so well, because they've seen them recovering that market post-pandemic. And it is services. So I don't think tariffs, because tariffs are on goods, that shouldn't impact Manulife's services, because they're providing, services, and it's local. It's not like they're exporting services to China. They have local operations or to Hong Kong. But I guess the risk is that there's animosity, and who knows, like maybe there's going to be a less demand for their service. But Manulife is also Canadian; it's not U.S. So the perception that countries will buy less U.S.-based services or from companies, U.S.-based companies.
So it should escape all of that. Yeah,
it should. But obviously, that is an area that that is where the growth is coming from, and we know that Hong Kong and China. I mean, it is an autocratic economy, so there is that risk. But the market, the life insurance companies, and Manulife included, has pulled back just because potentially if there's a slower economic growth, that's going to impact all companies, including life insurance companies. They tend to be more defensive, but within that area, within the financial services area in Canada, we've decided to stay with the Canadian banks versus the life insurance companies.
Got it. Okay, let's go back to the phone lines. Bill is calling in from Bowmanville in Ontario. Hi, Bill.
Thank you for taking my call. I'd like your guest thoughts on LIN, the Lin Group. Does she own it, and does she see growth ahead? Thank you.
Okay.
Thanks for calling. Yeah,
so Linde is an industrial gas company, very global. They merged with Praxair a few years ago, and we do own it in our client portfolios. And I would call it kind of it's categorized as under the materials sector, but I would call it kind of like a soft cyclical, because what they provide, their gases, they have actually on-site facilities to provide chemical plants, any operations that needs their industrial gases, hospitals, they provide carbonation to restaurants, semiconductor plants need a lot of industrial gases. So a lot of their services is very recurring in nature. So it is more defensive. Company is very, very well managed. They always say that they can grow their earnings high single digit regardless of the economic scenario, because they will adjust their cost base. And most of their contracts, they can pass through any increased input costs to their end customer. So for it to really grow, though, the earnings, they need economic growth, because that's what drives their customers are in sectors that will expand and grow if the economy is growing. Semiconductors growing regardless of secular growth. In certain areas are more defensive, healthcare, semiconductors, and restaurants, et cetera. But we own it. We do think that they will ride this out, and longer term, they're going to outperform in any economic cycle.
Interesting. Okay, we are going to take another quick break. Christine will stick around to take more of your phone calls when we come back. Welcome back to Market Call. Let's go to an email. Ken has written in. He says, I'd like to get Christine's thoughts on Canadian Apartment REIT. Let's have a look at that graph. And what is your take on
we like
REIT?
Canadian Apartment REIT. It's an income stock we own in our client portfolios. It's the largest publicly traded Canadian rental market company.
Why has it been on this downward slide sort of since last fall?
Well, okay, so first, we know that regardless of what the stock price has done, I think that demand for rental housing still outstrips supply.
Okay.
But we've had the government announce decreased immigration coming into Canada.
Yes.
Decreased international students. Mm-hmm. And so as well, we also know there's a lot of condos coming on supply,
the market,
on the market, and the condo market has been very weak. So that's been the overhang on Canadian Apartment REIT. Having said that, I don't think they tend to, the units they have are not in, the condo market is usually more urban and smaller square footage. Canadian Apartment REIT tends to be outside of the urban areas.
Okay.
And larger apartments, like 2-3 bedroom apartments.
Got
okay,
it.
so they're not going to be directly impacted, but regardless, that's been the sentiment that's caused the stock to pull back, I think. And as well for, and so like rental rates have been starting to soften a bit because of the condo market. But for Cap REIT, they have operations in Ontario, it's about 40 to 50%, in BC, and there's like rent control. In Ontario, even when markets were very strong a couple of years ago, you can only increase your rent by 2.5% for buildings that are built before 2018. The rent control doesn't apply for newer buildings. So they were actually not able to implement the rental increases, and turnover was very low, meaning people were staying in their apartment because they couldn't find another place to live. So their rent in place is much lower than what the market rent is. So, I think that hopefully if the turnover actually goes up, because people think, okay, now I can move into a condo or buy a condo, that actually should benefit Cap REIT, because they can actually then do some renovation work and increase
make some more on that same
exactly.
apartment.
So they have a long headway or runway to do that because of their lower rents in place. So I think that this stock, and as well, they've been recycling their portfolio, meaning they've been selling a lot of their older properties that are potentially under rent control in BC and in Ontario, and reinvesting in newer properties that require less capital spending requirements. And thirdly, interest rates, because they have been going up. I mean, they were up, now they have been trending down, but it's actually not very economical to build new developments in properties. So that's why they've been buying existing ones that are almost pretty built up, and going for will require less capex. So we think that it provides a nice distribution yield. I think it's just under 4%. And there's a long, the secular outlook for Canadian rental housing. Multi-unit housing is very attractive.
And you mentioned they're outside of urban centers, outside of the urban centers, more for sort of families or people downsizing back to apartments?
Yeah, or 2 bedrooms, 3 bedrooms. Like, not everyone can live in a house, right? We all think that everyone has home ownership, but that's not the case. And their average rent in place is around $1,600 a month.
Got it. Okay, let's go to another email. This one is from Jeff. He says, is this an ideal time to buy RY? Where do you see the stock moving going forward?
So Royal Bank is probably our top holding in the Canadian banking sector. I do think it's a good time to buy it. The multiple has contracted. It's pulled back along with most of the financials because of the prospect that the economy is going to slow, and perhaps you're going to have increased loan loss provisions. The banks have, as a group, have been increasing loan loss provisions for the past couple of years, and coming into this year, I think most bank executives thought that we would start seeing the positive impact of lower interest rates in the back half of this year. But now you have this tariff scenario, and no one knows the uncertainty about how that's going to impact the economy. Having said that, the bank is diversified. They have a very the retail deposit base is a very cheap source of funding for loans and mortgages, so that's a competitive advantage. And as well, they bought HSBC Canada about a year ago, I think it was, and that integration has gone very well. And I think that will be a source of future growth for the company as well. The dividends attractive, not the highest in the group, but the bank has been increasing that dividend by a small amount each year. We expect that should continue.
Got it. Okay, so let's do another email then. This one is coming from Brenda, and she says, what does today's guest think of George Weston? And she has a nice note for you there. Love when Christine is on. She's one of my favorites. So George Weston.
Yeah, so George Weston is the parent company of Loblaw. Okay. They own, I can't remember the exact percentage, but a majority percentage of Loblaw. And as well, they have a real estate operations, which is primarily the real estate that Loblaw and Shoppers is located on. Okay, so George Weston, like the stock has also done well because on the back of Loblaw, because obviously as Loblaw stock does well, then they report the earnings flow through to them. So it's a defensive name, same like Loblaw, not that cheap because of what the stock's done, the underlying operating companies have done, but I think it's a good name to hold in this kind of environment.
Okay, so pretty much the same on par with Loblaw as far as it's defensive, moving in this climate. Yeah. It's a good one. You dip in even at that point.
Yeah, I mean, I think even for Loblaw, though, I would wait for a bit of a pullback on the share price to buy it.
Got it. All right, that is all the time we have for phone calls today, but stick around. Christine will share her top picks. That's coming up. Welcome back. Christine Poole is with us, and she's going to share her top picks. The first one is CGI on the TSX. Tell me why you like CGI moving forward.
Yeah, so it's an IT services consulting company based in Montreal, but its operations are very global. Canada represents about 15% of their revenues, the U.S. about 30%, and about 44 to 45% is Europe and the UK. Just the function of the various operating divisions they have. And so CGI, they have two segments. There's the outsourcing side, managed services, and there's the consulting side. So outsourcing is about half their business, just over half their business. And so these are long-term contracts where businesses outsource their back-end office, et cetera, to CGI. So very long-term, recurring nature, defensive. So we like that. It's not as cyclical. The consulting side does tend to be more economically sensitive. The companies may, wait to, do a new contract with them if the economic conditions are deteriorating. So the stock has pulled back about 17% from its highs in mid-February. A few reasons why. They do business with the U.S. federal government. It's about 14% of their revenues. And we know that DOGE, Department of Government Efficiency, has asked everybody that asked the
cost saving
and to terminate non-essential contracts. So there was a risk that some of CGI's contracts may be terminated. I think they're largely insulated because they're very long-term relationships, and they do provide mission-critical services like passport processing, et cetera. But that's been an overhang. And then one of their peers, Accenture, reported a few weeks ago, and they indicated that they're seeing companies kind of slow their decisions on making new contracts because of the uncertainty. So near term, that may result in a softer backlog. But we think long term, IT services is essential if companies want to decrease costs, increase productivity, and they're going to need their services. So trading now at about a 17 times multiple. Meanwhile, they've been increasing their M&A activity. They've bought about 4 tuck-in acquisitions this past year, largely based in Europe and the UK. And so they've got a strong balance sheet. They can grow that way as well. Okay.
And will they be hard hit if they are cut or their contracts are cut from the American government, or at least some of them?
Well, it's about 13% of their revenues, so I don't think all of those are at risk. Like maybe potentially a small percentage. So I think they can grow through that.
They can weather that. Okay, let's get to your next pick, which is J.P. Morgan, New York Stock Exchange. J.P. Morgan, of course, the big U.S. bank. What do you like about them moving forward? And I want to throw in the fact that we might hit a recession in North America, and is that a concern to you?
Yeah, I think J.P. Morgan, and why we like it, it's our large cap U.S. bank that we in our client portfolios, the largest, leading global bank, in fact, and #1 shares in most of their franchises. And, they're very efficient, lowest overhead ratio of all of their competitors, highest ROE, and they have a very, very strong balance sheet. That's kind of been their mantra, having this fortress balance sheet, meaning they have a lot of cash and marketable securities on their balance sheet. And we saw back in the regional banking crisis back in March of 2023, the Fed actually approached them to buy First Republic, which was a regional bank that was getting in trouble because of rising bond yields, and so bond prices were coming off. And so they got the opportunity to buy it. The company had very attractive, under very attractive conditions, and likely, any other time they wouldn't have been allowed to do that because of their scale already. So, they reported last week, very well managed. Jamie Dimon is the CEO. And, he kind of says, they have the balance sheet is very liquid, and they will, I think, do well and outperform their peers in any sort of economic environment. There is obviously uncertainties regarding tariffs and political issues, but the stock has pulled back also about 70% from their highs in mid-February, trading now at a much more reasonable multiple at about 12.5 times forward earnings, and they just increased their dividend by 12% when they reported last week.
Okay, so good time to dip in.
Yes, absolutely. I think so.
Let's go to your third pick, which is RTX Core, which is aerospace and defense. And what do you like about them?
Yeah, so this is a name we've held for a number of years. So commercial aerospace, they make, Pratt & Whitney and Collins are the brands there. Engines, landing gear, propulsion systems. They have both commercial aerospace and defense exposure in those two segments. And with a lot of their businesses there's original equipment and there's the aftermarket, which is the servicing side, which is very profitable. Once again, very recurring, long-term in nature. So this makes it the company less cyclical in terms of their earnings profile. And then on their defense side, they've seen very strong demand from the U.S. as well as from international orders. And I think that they exited with a very strong backlog in defense, and they actually said that international actually represents about 44% of their defense backlog now, and it tends to be more profitable. And with with these many countries wanting to increase their defense spending as a percent of GDP, there will be some orders that will flow to RTX because they make products that they can't probably produce domestically. So that will be an area of strength. And given all the geopolitical turbulence we're seeing, I think the defense business is going to stay pretty sound.
Yeah, I was going to ask you whether or not you see sort of the conflicts that are ongoing and conflicts that we could see sort of popping up. That would be a benefit to them.
I believe so, yes.
Got it. Okay, we do have to leave there. Christine Poole joining us today with all of her picks and her good advice for the investors. Thanks very much for joining us here on Market Call. Let's take a quick look at the markets as we head to a break. We are down 284 points on the TSX, down 152 on the S&P, down 516 on the NASDAQ. So a down day so far. Thanks for joining us. We'll see you again tomorrow.